Let's focus on Bajaj Auto now. The stock is under pressure, but the earnings were good. Their margins have been up over 20% for the third straight quarter. The new CNG bike has seen a very strong response. We have with us Rakesh Sharma, the Executive Director of Bajaj Auto, to talk more about that. Mr. Sharma, good morning. Always fun chatting with you and trying to understand more about the industry. So this time, your revenue growth was around 16%, led by a 7% volume growth. What is the outlook on Q2? Is it possible that because of the kind of recovery you're seeing in exports, in Q2 and Q3, there is a possibility of hitting double-digit volume growth as well? And how are the demand trends now?
Good morning, Sonia. The demand trends in domestic are looking, nice at about 6 to 8% underlying growth for the industry. And as usual, it has been driven by the top half of the industry, which is growing at double digits. So we have been outpacing that in the last few quarters. And domestic has actually delivered 9 successive quarters of double-digit growth. And we see that in a similar way. That's how Q2 and hopefully Q3 should unfold. In the export side, Africa is still down. We are down about 40% in Africa compared to last Q1, and that's largely on account of Nigeria. Though the currency has stabilized over there, but there has been such a savage devaluation, which has led to this inflation that the markets have, the demand has really got dented by that. But just to give you some idea of the kind of recovery which is there in Nigeria, we retailed about 5,000 units only in April, and our benchmark is 50,000 units per month. But in June, we retailed about 15,000, way below the benchmark, but, much better than what we did in April. All the other regions, which is Middle East and North Africa, Asia, LATAM, are showing strong double-digit growth. So overall, I think exports should continue to grow as well as domestic. So we expect, obviously Q2 to be better than Q1 and on the similar growth trajectory.
Okay, so you're saying the demand trends are looking good, a 6 to 8% underlying growth for the industry in FY25, and you expect Q2 to look better than Q1. Got that? I'll come to exports in a bit, but this has been a good quarter for you once again in terms of margins, right? Not just 20% plus margins, but realizations have also picked up compared to what we've seen 4-5 quarters ago. Is there scope to build on to these margins further for the rest of the fiscal, or do you think raw material pressures could keep the lid on top of the margins at this 20% mark itself?
See, the margin is a blended margin of not just business units, which is international and domestic and three-wheelers, etc., and also the rise of the EV business. Now, total EVs, which is three-wheelers and two-wheelers, account for almost 14% of our top line. So the other aspect to highlight is that, this has gone from 2% a year back to 8% and now 14%. And obviously, these are at a much lower margin. They're margin dilutive at the corporate level. Despite that, we have maintained 20%, and that's because of a great mix, both in domestic and exports. We are not seeing too much of a commodity pressure. There are some commodities which are on the up. There are some commodities which are on the down. So it's sort of cancelling out. And we are hoping that our continuing improvement of mix and realizations will offset the rise of the EV business. And quite separately, I must also add that there is a continuing fall in costs in the EV as we scale up and as supply chain and R&D bring in better sort of cost architecture. So I would say we should be on the similar path in the margin trajectory too.
All right. Hi, good morning, Mr. Sharma. So similar part on margins, you believe that, the measures that you all have taken rising input costs, they could offset each other. Got that. What about EVs? Since you briefly spoke about that, it's moved from, I think, around 3 to 5% to around 14% of the total mix. Where do you see that number headed?
Well, it's going to go up and up because we've made a very significant move in the closing days of June when we have launched a high quality but more affordable Chetak, which is sub 1 lakh. Almost 50% of the two-wheeler industry is now at the sub 1 lakh, and we were operating at above 1 lakh till now. Now, it does two things. It opens up this big segment for us, as well as it gives the ability to now widen our distribution, which work has already started. We were in 200 odd stores in April. We are at 500 by end of June, and we should be in 1,000 in another couple of months' time. So both from a geographic point of view and a consumer segment, a big new segment is opened up, and we will see Chetak performance strengthening substantially in the coming months.
You want to give us a number, though? From 14%, what can it go? Give and take everything.
Well, we would like to, maximize it, but it's difficult to give you a number because there are other people and also there, and we have to wait and watch as to what will be the competitive reaction to this surge in Chetak.
Okay, got that. Just two questions on the market share. The market share in the 125 and above cc segment has been very strong at over 40%. What are the targets there? Do you think you can build on to that by the end of FY25? While in the 100 to 125 cc segment, there's still a bit of a struggle, both for the industry and for your own business. So you're sitting at 15% market share there. Both those segments, what do you see as the market share by the end of the year?
Well, we cut it 125 and above, where we are at about steady at about 25, 26%. If we get a couple of percentage points more, then I think we should be at a leadership position. We have completely refreshed our Pulsar range, and there are still a couple of new products in the pipeline for this year. And this refreshed range, as well as the high-end Pulsars, are now 70% of our Pulsar portfolio. So we are going to be, we are optimistic about continued share gain in a growing market in the 125cc plus segment. Now, in the 100, 110 cc, but you're right, if you look at it from your lens, the way you have looked at it, if you combine 100 and 125 cc, we are at about 15%. And, obviously that's not a satisfactory position. But that's exactly where Freedom 125 has been aimed at. We tried a few things over the last 3-4 years, both on the product and price front, with very marginal incremental gain. But with Freedom 125, our aspiration is to, make significant inroads in the 100, 125cc segment.
All right, Mr. Sharma, we wish you the best of luck. Thank you very much for joining us here. Good perspective as always. And thanks for joining us.